morning, all. Have a wonderful day. And I think we are at an exciting time currently because this year will be a globally election year. So, if you look at not just in India, across the world, even in US, we have elections. And recently, if you look at in Russia, also we have seen the election results. So, I think this year is going to be the election year, and I think a lot of impact of policy level changes we will be able to see based on the election results. And I think it become very critical from an investor perspective to take advantage of this special scenario, because many a times what we have seen that election could be ideal time for generate higher return either through a profit booking or doing an investment in market. Because in our view, I think if you look at in general, long term markets are run by the change in the overall financials and the profitability of the company. But during election results, pre and post, we have seen a lot of euphoria come in the market. So I think that is the ideal time. What we say that we should take the benefits. Normally, if you look at, I think if you look at from a current scenario perspective, most of us are expecting that same government will repeat, and election may not be an event which impact market significantly. But fact is, sometimes we have to be prepared that in case if any major change happen because of the election results, then we should be able to capitalize that opportunity. I think that is the whole idea of this session, to make it prepare in terms of how we should plan our investments based on elections results. And before we look at on the elections, I think let's look at on the outlook from the market perspective. I think if you look at India from an India perspective, I think this decade is going to be for the India, and that is something which we are able to see. If you look at the graph, how we have come up in terms of the economic growth perspective. I think by 2027, India will be the third largest economy. And I think if you look at end of the Amrit Kal, that's what government is trying to project, that will be second largest economy equivalent. So I think it is a golden era for India. And the one thing which we are able to see as a major change today is that the growth of future India is not with only some sectors. So I think it is across all the sectors which is going to do well, and which is going to be added with our demographic dividend, and the way India has developed both physical and digital infrastructure that is going to be built long-term sustainable growth. And the growth is completely done through clean energy focus, rapid financialization, and what we have seen that the government focus is building the growth more, giving incentive for the growth than giving any sort of a freebies, because I think that is something which is going to build more long-term sustainable growth from an India perspective. And if we look at from a GDP growth number perspective, we can see that how we are being a highest growing economy in terms of GDP growth perspective, which clearly shows that I think our growth will continue to be drive, and stable economic policy is going to add further, because what we have seen over a longer period of a time, major part of FI's allocation in terms of foreign inflow, be it from as a FI or FDI, will come for the stable government, because that will give a clarity in terms of the policies perspective, and it will help to take them the long term decision call. So I think that is something which we are able to see as a whole. And overview is that I think the next leg of growth will be sectors which are manufacturing will be lead the whole growth along with the digital side. So I think the sectors going to drive the Indian growth will be different from the sectors which have done well earlier, because India as an economy, if you look at post COVID, I think it's grown very significantly, and we have seen uh, post any crisis, be it 2008 financial crisis or COVID, India has emerged much more stronger, especially on the manufacturing side. So sectors like auto, pharma, infra, or on the digital, these are the sectors which are going to do well from the future perspective. So we always talk about that, okay, India is doing good and all things are positive. But end of the day, I think from an investor perspective, what matters the returns, what they generate. So just to showcase that, people used to have a myth that okay, India may have would have given a good return, but from an NRI's perspective, I think what matters to them is that what is the overall return for taking currency into the consideration. So if you look at except US market, if you look at India has been consistently given double-digit return over a period of last 5 to 10 year and 15-year perspective, and it has been a very low volatile. I think that is the most important part. I think more than return, I think the consistency of the return. And if you look at last 10 years, we have not seen any sort of a negative return. So I think that shows that India is building the growth on a very sustainable basis. And I think if you look at after India, all other emerging markets performance. And China, even if you look at from an economy perspective, they would have grown significantly. But if you look at from a capital market perspective, China has been on a negative return side. If you look at even a 10-year perspective, so that shows that it is not about only the growth. Because normally we always talk about that. Okay, if economy is growing, their companies' profits are growing, then markets will do good. I think the most important part which comes is the quality of the growth. Because in India, at least companies are not get controlled by the government, and the economic policies are more driven from the perspective which is equal for all the stakeholders. So that shows that the quality of growth is good. And the major part, if you look at, I think foreign players also will have a more trust where the policies are not changing frequently. And that is where I think China has failed because they have changed their economy's policies irrespective of looking at the impact from the on the external partners. So I think that is somewhere which shows that India will continue to do well, and I think this is the time for us to take off. And I think the next 10 years, it is not just 1 or 2 years. I think next 10 years going to be the high growth for India perspective. And what is going to lead the growth. So I think that is the most important part, because people always have that concern that how India is going to do well on a comparative basis. So if you look at on the infra side, the way India has developed, be it on the airports we have developed, on the railway side, if you look at the number of kilometers we have added in this era, or even if you look at the road, so almost 146 kilometer we are building it in every day. So I think road and all these basic infra which we have developed, I think that is something which is going to drag the growth. Apart from the digital side, what we have done through UPI, Aadhaar, and financialization of the assets, I think combined approach. So if you look at India is doing a digital approach where they are building a physical infrastructure. Along with that, we are building the digital infrastructure also. So that is going to make the growth which is able to reach to a last milestone level also. I think that is the most important part if you look at overall perspective. I think maybe Sanjay, we can have a poll. I think everybody would be have their own things in mind in terms of how post elections Indian markets going to behave. So I think maybe if you can have a poll and that can give a general idea in terms of what everybody is thinking from a market perspective, then we can give our view. What is our view on the markets? Yeah. So poll is what is the expected level of Nifty post election in next 3 months? So we are currently around 22,000 index level. Think most of us having a bullish view that I think same government will come and things will be on a positive note. Yeah, so maybe we can end the poll. Yeah, so I think majority of us has looked at that markets going to react positively, and we can expect another 5% up move from here. If you look at, so 45% has given a 23,000 level, 27% for 24,000, 9% for 21,000, and 18% that we will be at the same level. So I think it is in line with our expectation. In our view, also, I think we don't see that there will be a very sharp move post election. The reason is because post state elections, markets have already factored in the same government is going to come back. Now, the only difference what market is expecting that what is the level of majority in terms of the number of seats, what the government is going to come back. I think that is the only area where markets is looking at this point of a time. But in our view, I think if we see 10% type of up move just because of election results, I think that would be a good way to do some part of a profit booking because yeah, we will take you to the next slides where we'll show that election results are not going to have a long-term impact in the markets except if economy as a like the companies are not doing good on that basis. So I'm saying anything which is just because of the elections, that would be ideal time to rebalance the portfolio and make it our portfolio as per your asset allocation. Don't get carried away thinking that elections results is going to change the whole economy in a short period because uh, the overall growth of economy is going to be next 5 to 10 years. It's not just going to change with one day of a results. So considering same government is there from last 10 years also. So in our view, if we see up to 5% up move, that is okay. But if we see like a 10% plus type of up move, that would be a ideal time for some profit booking. And because of any reason, for example, if market correct more than 10%, then we should go aggressively on a buying side because if you look at overall our economic growth is very strong and any sort of a correction would be ideal time to increase the equity allocation. Just to give that how the in different time elections before results and after election how the markets have reacted. So if you look at I think majority of the times we have seen that markets have given a clear mandate before results itself, and where we have seen that any sort of a major negative result, major side, any sort of a negative thing happened with against expectation, market has reacted negatively. So we can see in 2004 where UPA came into the power. So that time market has reacted negatively. But I think the most important part as an investor for us to look at what is the impact after 1 year. So if you look at post 1 year, if you look at next 1 year, market has given phenomenal return, almost 23% return. So that shows that we should not worry about the election results. We should focus on the quality of earning growth, and that is something which always going to help. So if we see any larger correction in the market because of the elections, we should take the benefit and we leverage. Same way, I think if we see any sharp up move in the market, then we should take that opportunity to book the profits also. So that we can see in 2009. So for example, post elections, markets have moved up. But if you look at 2 years of a return in 2009, it is 7%, which means markets have corrected after that. So the ideal approach would be that any sharp move on both the side would be ideal time to do portfolio rebalancing. We are not suggesting like we should do a complete exit or entry of the portfolio, but at least we should follow our asset allocation, and based on that, I think we should build our portfolio allocation. This is a graph view in terms of how markets have moved over a period of a time. If you look at, we are able to see that even when Congress came into the power, still markets have given positively. So one thing which is very clear is that from a market perspective, be it Congress or BJP, I think in terms of the policies, most of the policies are in line in terms of focused on higher growth. It's only that when it came as a coalition government, I think markets have reacted negatively. But one thing which we have to look at that post elections results also, even when BJP came in 2019, we have seen markets have corrected significantly because of the reasons which are not linked with the election. So sometimes it's always makes sense to take opportunity. Same we have seen that when Modi government came, markets moved up, and then we have seen the profit booking coming up. So we should not expect that markets are going to have a one-way rally. It will see some sort of a profit booking also coming up whenever there is a sharp up move coming in the market. And I think this is the best time to look at in terms of how markets been volatile in 2019 in terms of it has moved up, corrected, and then taken an up move. So I think that show that markets could be volatile things, but we are not expecting this time same thing going to happen because the clarity is that same going government is going to come back. And this is just a brief in terms of how in different time markets have reacted and what was the reason for the market move. So in 91, I think predominantly, I think the way we were going through a fiscal deficit crisis that has impacted. And after that, if you look at 96, 98, I think Asian financial crisis and the political unrest that has impacted. 99, I think NDA came into the power, and that is something which make markets to going up, and even economy also we have seen going up. 2004, I think markets have seen major decline because NDA was expected and Congress came into the power. So sometimes it's about same thing which is going to happen now. Like for example, our overall expectation is that NDA will come because of any reason. For example, if uh, Congress came into the power, so market will react negatively for short period. But after that, market will start again looking at the corporate earnings. The essence of this webinar is to not to go sentimental with the election result. Focus on our overall quality of the earning growth, and which we believe that continue to be. Then when 2009 markets came, same government came, market moved up, but that was not continue for long period because there are a lot of corruption and a lot of things which has happened on the negative side. So when Modi came back, market reacted very positively, and if you look at markets have moved significantly. But after that, if you look at market settled down, and it has not had very sharp up move after a period. And I think 2019 same government came back, so I think that is something which made up move, and things are settled down. So that we can see here in 2019 when BJP remained in the power. So if you look at move was not very sharp, then market corrected, and then it moved up. So point is we should not get carried away with that and take the decision based on your asset allocation. I think from an NRI perspective, I think what are the things which is going to make sense because if you look at how the overall remittance to India, so currently if you look at by 2023 it was almost 125 billion dollar, in 21 it was 87 billion dollars. So if you look at remittance has increased significant way, and uh, keeping into the mind why India is an attractive destination for NRI, one is on the return on investment perspective. Second, from a diversification perspective, not to keep everything in a one market. Third, most important part, which is coming up, many of the NRIs are looking at coming back to the India from a retirement planning perspective, and being building a legacy perspective, I have asset allocation in India. So I think India is becoming a very attractive in terms of the overall perspective. And I think what all the services we have provide in terms of the overall perspective with our partners and overall, in which I think predominantly I think retirement planning is very critical, which we help our clients apart from helping on the other angles with our trusted partners. What are the different investment options? I think from an NRI perspective, today I think there are a lot of options which are available, and if you look at with time, options are increasing. Today we have investing into a commercial rental yields, NPS, direct equities, mutual fund, fixed income, PMS. PMS has become a very large portion apart from AIF as an investment option for HNIs because there we can they can expect higher returns. The whole approach, we believe that it should be based on their investment goals and based on their risk appetite, and it should be a very well diversified portfolio. I think many a times what we have seen that people get carried away just looking at return, and they don't focus on their goals and their risk profile because everybody have a different risk appetite and their different goals. I think that is the core thing which we try to educate and try to build a portfolio looking at their goals based on their risk profile. And the most important part to diversify. So we should not just try to chase asset class which is giving the highest return. Even we our objective is the wealth creation because if you look at in a different market cycle, different asset class have done different returns. So and within equity also, if you look at large, mid, and small cap have moved significantly different ways. So, for example, if you look at this year, mid and small cap have given a phenomenal return. If I look at the whole financial year, last 1 year, mid and small cap have delivered almost 40 to 50% return. But at the same time, large cap have given 15 to 20% type of a return. But the point is, what would be the future allocation? So, in our view, I think large cap will do well, and mid and small cap will have a higher risk in terms of the growth perspective. So, we should not look at the past returns and get carried away. We should look at the overall future growth thing and the risk also. So, if so, sometimes taking high risk doesn't mean you are going to get a high return because the most important part is the earning growth, which is will be more stable for the large caps. And what are the tax exemptions for the NRIs? Because that is the most important part. Because we always believe that we should look at the post-tax return, not at the pre-tax level. because I think that is something which going to make a difference. So I think first is interest earned on the NRE FCNR account, then on bonds, then if somebody is doing towards capital gain prospective investment, there they can claim the tax exemption. Apart from that, I think one of the interesting thing which has come up, especially for countries where we have a DTA agreement. As per rule, if you look at especially on the mutual fund investment allocation, they can get the exemption on paying the capital gain tax. So, especially countries like a UAE where the investments are exempt from a tax perspective, and India has signed a DTA agreement with UAE, which means if somebody have a tax residency certificate from UAE tax authority, and they can get the form 10AF from the Indian tax portal, and they can claim for capital gain reduction refund. That is something which was there as a rule, but I think now slowly things are coming up, and clarity is coming up on that side. So I think on the mutual fund side, that could be a good option to safeguard the tax, but there are a lot of costs involved in terms of getting this certificate. So these things make sense when someone have a large capital gain on the mutual fund side to look at, and we can help for someone who is looking at this. So this is something which is the new thing came up. So we thought to give a update. How it's going to be added value in terms of saving a tax perspective. Then we look at what are the different options in a current scenario which somebody can look at. One is, I think, the most important part. As today the interest rates are at a peak, and your view is that it can come down from here. Someone who is looking at to retire in next 10 years, a 5 to 10 year perspective, and they wants to come back to India, and they want to build a regular income source. So there are pension plans which are available, which can give tax-free guaranteed income options. If that can be done at a family level, 5 lakh of investment, because there is a limit of 5 lakh on the same. So we've just given an example. If somebody is paying 10 lakh of investments for 10 years, so they can get 12 lakh, 21,000 of income for next 25 to 30 years based on their requirement, along with getting the return of capital, which is effectively, if you look at it, as 7% actually guaranteed IRR. More than that, I think the most important part is getting the regular cash flow, because today the biggest challenge what we have seen in other investment, there is no regular cash flow. Majority of the investment option give a one-time money, or if you are getting a regular cash flow which is taxable. So from both the scenario, it add a lot of value. And secondly, you start getting money when you need, not now, because that's another myth people have, that okay, I can put same money into the FD also, but the challenge is, do you need now money? And secondly, the most important part is that you are locking your money at a higher interest rate. So that makes more sense, because if you look at every 10 years, we have seen interest rates are going down by 2 to 3%. So from 12 to 14%, we came down to 9 to 6%. And our view is that next 10 to 15 years will be at a 3 to 4% type of an interest rate scenario. But this is not suited for everyone. This is only for someone who wants to retire the next 10 years perspective, and looking at the regular income post retirement, and they have a good growth asset. So this cannot be a only allocation of from a portfolio perspective. That could be only a part of thing. That's the first thing which we are suggesting in a current scenario. Secondly, I think the other thing which we look at is the dynamic funds, where the advantage of dynamic funds is that at a fund level they manage debt to equity allocation. Because most of the time what we have seen, that people always have that concern that okay, if I entered into the market when markets are high, then I may lose out a significant part of the growth. So, in our view, to make the simplicity of the thing and to get the returns which is higher than inflation, I think hybrid funds or dynamic funds add a lot of value, and still people have not realized the full potential how to utilize that. And I think that can add a lot of value because they help at a two level. One is you don't need to worry about the market timings because at the fund level they will do the changes in the debt to equity allocation. Secondly, the most important part, you will get saved from the capital gain tax every year, because at a fund level, every time any changes happen, that will take away. And third, you can plan your liquidity requirement based on your objective. So we have just given an example that one of the fund where we have taken a long-term data that somebody has done 15 lakh of investment, even if he's doing a monthly 10K of a withdrawal, what will be the portfolio value and total how much is the withdrawal? We are keeping that 8% is the withdrawal rate. So if you look at the overall IRR post tax, also it is coming around 11%, which is very good, which is higher than inflation number. And secondly, the whole process is where your investment is completely liquid and which is on the lower risk side. So I think that could be the another option for someone who is looking at on a moderate risk. So we have given a three options. One is low risk side. We have given a guaranteed income plan. Second, on a moderate risk, hybrid funds could be the option, which typically how they manage. So balance advantage fund. First thing, predominantly they focus more on a large and mid cap, so they take care of the risk part, not going to small cap. Second, on the asset allocation, they dynamically manage debt to equity allocation between 30 to 80%, and do some part of a hedging or rebalancing as a, with their derivative strategies, which will be a smaller thing. And then later part, SWP can be used to create a regular cash flow, which is more tax efficient, because in India, if you look at on the equity, even somebody have a capital gain, it's only 10% compared to other instruments which have a higher. For NRIs, if DTA is there, so even they can save on the tax side also. And there is no issue in terms of exit load perspective on the early withdrawal, so that the liquidity part always remain with the investor. The third case study which we talk about, that from a growth perspective, so someone who is looking at to do a larger wealth creation, I think PMS has come out one of the very good option apart from equity mutual fund, because PMS make a lot of sense for someone who wants to create a customized portfolio and want to have a complete control and understanding of the investment, because as the portfolio size become bigger, people would like to have the understanding in terms of how that money is being managed, and they want to regularly interact with the fund management side. And we have been consistently doing very well in all the categories. So in all the three categories or fund, be it on large, multi-cap and mid-cap, so we have done phenomenally well, and even compared to the market. The idea is not to suggest that PMS is the only alternative, but I think PMS also could be one of the option to look at as a part of the asset allocation apart from equity mutual fund, in terms of to create higher wealth creation and create a customized portfolio based on the requirement perspective. And just to take in the last, that we always have the myth that because of the currencies, I think markets, even we get a good returns post when we are taking out, may not be. But if you look at last 1 year, this trend is getting changed. So if you look at in the last 1 year, overall USD INR return, if you look at it, hardly 1%. So that's one thing which we're trying to communicate and educate, that the way earlier rupee was depreciating, I think it may not happen in the same way. The reason is, if you look at, there's a large inflow which is expected in Indian market through FIs and FDI. Apart from that, on the debt side also, now Indian bonds are added to the global bond index. That also will bring huge liquidity in the Indian market. So as of now, people have not seen the benefit of the same. So I think both the side plus the remittance money and other things. So I think in our view, we should not expect more than 1 or 2% impact because of the currency. So earlier, it used to be like a 4 to 5% impact on the return, which used to be a larger factor. But what we can see from the last 1 year, the trend is getting changed because there are a lot of fundamental factors which are changing. The impact will be comparatively low to the thing. So India is going to be good destination, and I think government also is working. So gift city is something which we will maybe discuss even later part also. So this is the new thing which is happening in India where NRIs can invest money into directly in the dollar terms instead of doing a conversion to all the investment products using the gift city route. So still it's at an early stage, but I think things are very clear. I think next 3 to 5 years you will be able to see that a lot of products will come through a gift city route, which is more ideal for the NRIs. So already there are multiple AIF have started and the PMS has also started in the gift city. Next level, we'll be able to see even mutual funds like HDFC mutual funds already applied for the same, but they will come with a higher ticket size. But I think overall, the way government is going directionally, they want to create a hassle-free investment approach for the investor, and Gift City is a first step towards that. And this is the overall tax reckoner for the NRIs. I think the major difference, people always think that being as the NRI, you may end up paying higher tax, but technically you're not paying higher tax. The only difference is that for NRIs, tax are deducted at source instead of you pay at a filing time. And in case if your TDS is higher than your actual tax liability, you can get a refund. So technically, you are not end up paying higher tax compared to Indian. And for UAE citizens, anyway, DTA is there, so you can claim the exemption also. And if you look at on the equity long-term capital gain, it is at 10%, and short-term is 15%. And if you look at on a debt side today, it is 30%, which is similar to FD. I think equity and the hybrid going to lead the growth from the investment allocation perspective. So I think that's all from my side. I think now we can have a question and answer. If anyone have any questions, we'd be happy to.
Thank you for valuable insights. I would like to request all the participants to write down your questions or queries in the Q&A section on the screen, or also you can write it in the chat box. We'll be taking it one by one. So I think we are already having one question in the Q&A section.
Yeah, sure. Yeah, so I think one of the question came that okay, normally most experts say election is a non-event. So why we should really do something based on election? I think, as you have seen in the my earlier slide, that election is a non-event in terms of the real impact perspective, but market always react. So the idea is that to take that reaction as a opportunity to look at and do the action. So if market doesn't move in a significant way, then we can continue in the same way. But if market moves significantly higher just because of election result, then we should do some profit booking. So idea is that be prepared for any side. So any side, if we take 10% up move or 10% downside type of a move, we should look at and do some profit booking based on your asset allocation. We are not suggesting that do a large exit, but take out some part of your portfolio or as per your portfolio asset allocation perspective. Yeah. So second question came, do we have a DTA with the Singapore? Yes, we have a DTA with the Singapore. The only challenge of all this DTA agreement is that for that, someone has to be a resident of that particular country and they have to get the certificate. So the process is not very easy to get it. So I think if you need any help, you can reach out to us because it has to routed through a tax experts. The next question came how I can get 10AF. So it will be available in the income tax portal. You can reach out to us with our CA partners. We will be able to help. But as I told that this all these policies are at the early stage, so somebody needs to look at that their tax status and they have to get the tax residency certificate from the respective country also. Yeah. The next question came, please give some suggestion to put the best share or mutual fund now. See, in our view, there is nothing called a best fund or best thing. It's all depend on the risk profile and your goals and the time period for which you want to do the investment allocation. But one thing which we can suggest that large caps today are more comfortable situation for someone who wants to do as a one-time investment. Mid caps can be do in a phased allocation. A small cap we would be suggesting avoid for a short-term allocation perspective. And secondly, I think the most important part is that use any correction as the opportunity to add the investments. I think that would should be the ideal approach than doing investment as a one-time as a allocation perspective.
Sir, we have few questions in the chat box. Can we take that also?
Okay.
Or you want me to read it out?
Yeah, I'll read it out. It's okay. People are holding cash. What is the right time to invest in election budget all and family? Our view is that people should not sit on the cash. So what we are suggesting that at least do the 50% deployment now and do the balanced money in a phase allocation over a period of a next 1 year. I think that would be the ideal way of allocation at this point of a time because we don't see larger correction coming in the market because of the elections. Okay. Do we have any answer or states where there is a correction in Nifty and around Nifty before elections? So we don't see that type of correction coming from an index perspective because overall Indian economy is at a strong level and we see that it should do well. What is the tax rules for returning NRI? I think for returning NRI, based on the number of days we being it in India, after that will be decided the tax thing, and it's going to be same for the returning Indian. So typically, it will be 10% for long term, and the tax liability will be during filing. So we pay at the TDS. So there is no major change in terms of the tax liability perspective, which is going to come. Uh, what is the best saving investment for NRI taking to India? Who is holding an NRI deposit which are tax free? I think for them, if they need a regular income, if somebody is holding money to NRI bank deposit, for them, some part of allocation to pension plans, if they need a regular income, could be the thing. Second, the balance or like all the hybrid funds could be the ideal allocation to get better returns than the thing. Third would be do some allocation to good quality large cap funds or stocks either through mutual fund, PMS or AIF route. So I think it has to be a combination approach based on the risk profile perspective. Can we get the recording session? Yes, we will be sharing post or in a day or two the recordings also. And if anyone have any question, they can directly reach out to me or directly to us. We have given our email ID also, which is sunil.kawariya@com. You can reach out to us. Any further? Okay. Is it a good idea to add index fund? Yes, index fund make a lot of sense from a allocation perspective because that reduce the risk in terms of fund doing better or not. So I think it is a ideal way look at index funds also as a part of allocation. But our view is that we should look at approach which is a mix of passive and active funds. So it should not be only passive funds because there are times where active funds will do better, and especially markets like in India, our view is that active funds still have a long way to go, and the combination approach is a better way than looking at only active or a passive funds. Can NRI based in USA get the refund of taxes in India if local income is below exemption limit? Yes, yes, they can get. So only thing which is required that you have to file the return. See, I think most of the time what we have seen as an NRI is we do a mistake that we don't do a tax filing. I think today it's very important. Even your TDS is not there, still you should file the return so that it create a complete record in terms of overall financial transaction perspective. I think if you do a filing of your return, you can get a claim. And as a house, we do a complete end-to-end support for NRIs, including support for tax filing to looking at anything which is required to help on any sort of a tech side also apart from the investment side.